Good morning. It's Monday, the 28th of October, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The take. A garment exporter I spoke to a few weeks ago told me he wished India would sign the much-delayed Free Trade Agreement or FTA with the United Kingdom because it would help companies like his. The current UK import duty for textiles from India is about 9.6%, while for Turkey, for example, it's zero, thanks to the UK-Turkey FTA. This puts the garment exporter I spoke to's products at a direct 10% at disadvantage as compared to the Turkish manufacturer, according to him. The FTA in question, for which discussions began in Jan 2022, have been circling the pit for some years now. The UK wants cuts in import duties on a range of products ranging from Scotch whisky to meat, chocolates, confectionery items, among other things, while India wants greater access for skilled professionals like information technology and healthcare, and then zero customs duty for some products, according to various reports. Now, access to skilled professionals is another way of saying easier migration, which obviously in many cases would lead to immigration. Not surprisingly, the FTA is stuck. If you were to note some of the rhetoric in the campaign trail in the United States right now, you would not be blamed for thinking the US economy is in the doldrums. Far from it. In the last 10 years, the US economy grew at an average of less than 2% or thereabouts. Last year, it grew 2.9%. And this year, the IMF says it will grow at 2.8%, but that figure is an upward revision of the IMF's own July forecast, which was at 2.6%. Bottom line, the US economy has not looked so strong in a long time. If nothing else, the US dollar is a good indicator driving down currencies across the world, including the Indian rupee. Strong economies and democracies also attract immigrants, including from India. Attempts by Indians to illegally migrate to the United States are rising. A report last week says that in the last year, some 10 Indians were arrested every hour while attempting to cross US borders. Some 44,000 were detained at the US-Canada border, the highest recorded figure for Indian nationals at that entry point. You have to remember that individuals who reach until that point are not poor by any stretch, having marshaled a fair bit of resources, including, of course, airfares and agent fees. And they are determined. Not surprisingly, immigration is the key issue in the US elections once again. Donald Trump, who, if one were to go by Wall Street and forex markets, is poised to return as president, has clearly set the agenda on this one and forcing even Vice President and opponent Kamala Harris to make commitments or at least make the right noises on illegal immigration. The surround sound around immigration is high. Tesla founder Elon Musk, for instance, has been repeatedly alluding to illegal immigration, has now quite openly thrown in his lot behind Trump. A somewhat unusual development, even in the United States, where some businesses can be open about their political preferences, unlike India, of course. Musk may have good business reasons to do so, but illegal immigration is something that he has been consistently speaking out against. As an aside, the Washington Post put out a report over the weekend saying Musk himself worked illegally in the United States on a student visa when he became an entrepreneur. Be that as it may, immigration extends beyond the workforce. Countries like Canada, Australia, and the United Kingdom are already clamping down on students from overseas, some more than the others, because today's students are tomorrow's immigrants. The core report pointed out several months ago that these countries would severely tighten inflows of students because, among other things, their own infrastructure, including housing, is being strained. And then there is the cultural context of immigration. To return to trade, India is unlikely to be on a strong wicket here if exports of people is a key point on the agenda, even if they are highly skilled IT professionals as they have been. Trump has been hinting at tariffs ranging from 10 to 60% on products imported into the United States if he returns as president next month. Now, a lot of this is aimed at China, but other countries, including India, could get hurt. Trade talks that would inevitably follow could see some rationalization of expectations, but access to labor markets is likely to be off the table, except in maybe small and very controlled measures. India is in a somewhat tough spot here, limited in product exports as well as people exports. But greater economic gain would lie in the ability of India's exports to enter countries like the United Kingdom at a lower cost, and thus keep India's factories, present and future, humming with activity, and thus hopefully creating more jobs along the way. And that brings us to the top stories and themes of the day. The markets see another brutal week last week, but will the coming one be better? India is one of the most attractive bond markets in the world right now. Revenue growth is the slowest in 16 quarters, says Crisil Market Intelligence. Can Indian tax laws have explainers alongside? And travelers worldwide want to go to less frequented destinations now.
This is the Core Report with Govindraj Ethiraj.
Markets have a bad week. What about this one? It's a week to go before the presidential elections in the United States. Wall Street is betting on Donald Trump returning as president as it sees him as more market friendly. Now, it's not clear right away what that would mean for India because Trump on his campaign rallies has been talking of higher tariffs which can hit parts of India's exports industry. On the other hand, bullishness on Wall Street tends to spread infectiously to other countries or markets, even if with a lag effect. Now, that's not happening right now, though, as institutional investors continue to sell off India and buy into China as valuations are cheaper there. But there is a flip side to that, and that's in bonds, and I'll come to that shortly. At this point, foreign institutional investors have sold close to $11 billion in October alone, even as domestic funds have bought heavily thanks to continued and sustained inflows, particularly through mutual funds. The BSE Sensex and Nifty 50 fell further on the final trading day of last week, that's October 25. The Sensex closed at 79,402, down about 662 points. The Nifty 50 fell about 673 points last week, almost 3%, to about 24,180 and was down 218 points on Friday. So the indices have now reported their fourth straight weekly losing streak, the longest since August 2023. Now, earnings growth in India is slowing down, and there is some panic selling by domestic investors, according to some market experts. More on that earnings bit shortly. So the bigger question is, of course, how much? From my conversations with institutional investors, they appear to be poised or perhaps geared for a 10% correction from the peak of the markets. That's at least right now. We're already past 7% or so not much further to go if that were the bottom, so to speak. The broader markets are weak too. In the last week, both the small cap and mid cap indices have fallen 9 and 7% respectively. Will that 10% rule apply here too? It's not clear to me at this point. India's surprising bond story. Global funds have invested nearly $20 billion into Indian debt, and India is shaping up to be a destination for investors seeking relative shelter from financial volatility linked to the United States elections, according to Bloomberg. India's divergence from global markets was evident last week when sovereign bonds remained relatively steady despite a global sell-off in US treasuries. While foreign investors are selling equities in India, as we've been reporting, they are buying into bonds consistently, making India amongst the top performers in developing markets this year. India's appeal is driven by broadly steady macroeconomic numbers and a stable currency. Remember that while the rupee is at all-time lows right now, it's barely moved in the last couple of years and thus wins out on very low volatility. So the rupee has hovered, for example, this year between about 82 rupees 80 paise and 84 rupees 10 paise per dollar this year, thanks to constant interventions by the Reserve Bank of India. Data compiled by Bloomberg says that the rupee has only shaved about 1 percentage point of the returns on Indian bonds this year, less than half the rate of currency-related losses on emerging market local currency bonds overall. Indigo Airlines reports a loss. India's largest airline has reported a roughly 990 crore loss for the last quarter in a move that surprised many. The airline has a roughly 63% market share. Now, this is somewhat important because of several reasons. One, of course, Indigo has blamed this on rising costs, including fuel. The lower profits also illustrate how vulnerable India's airlines can be to a host of factors, despite the growth potential and the increase in traffic. Indigo said the losses were driven by grounded fleet-related as well as fuel costs. Indigo has about 410 aircraft, and it had problems with engines made by Pratt & Whitney, which grounded some 70 aircraft in November last year. Thanks to which, Indigo extended leases on older jets and hired new ones, reported Reuters, which all led to overall expenses going up by about 22% for the September quarter. And this outpaced a roughly 14% increase in revenue. So note that revenue has gone up, but not enough to beat the rise in expenses. Meanwhile, fuel expenses also rose 13%, and supplementary aircraft rental and maintenance costs also rose about 30%. On the other hand, there was a 41% jump in airport fees. So all in all, suggesting that while airlines and aviation is a growth industry in India, the interim movement in costs, predictable and unpredictable, can make things difficult for the bottom line. Oil prices could ease off, but oil companies under pressure. Oil prices are projected to fall following some easing of tensions in the Middle East after Israel's attack on Iran did not hit key oil or nuclear targets. Oil was at about $76 a barrel overnight, but expected to ease off into Monday. Meanwhile, refiner Bharat Petroleum reported a 72% fall in second quarter profits thanks to lower marketing margins. The country's third largest oil refiner by capacity said its average gross refining margin for the April to September period fell to about $6 $12 per barrel from about $15.42 per barrel a year earlier. All of this is, of course, an indicator of rising oil prices, including from Russia, which was earlier available to India at a steep discount. Quite likely, other refiners will also face similar pressures, and the prospects of any price reductions at the pump now seem quite distant. Revenue growth slows. India Inc.'s revenue continues to grow, but at a slower rate of 5 to 7% year on year for the 3 months ended September, marking the slowest pace in 16 quarters, according to Crisil market intelligence. This is because of stagnant performance in the construction vertical. So, if you did not know this already, construction accounts for about 20% of India Inc.'s revenue. Also, a decline in the industrial commodities vertical and subdued growth in investment-linked sectors also helped. Crisil looked at about 435 companies that account for about half of the listed market capitalization. They all grew about 8.3% in the April to June quarter. Crisil says that revenue of industrial commodities, investment and construction-linked sectors collectively accounting for about 40% of their sample set only grew 1%. The industrial commodities sector, such as coal, says Crisil saw a 6 to 7% revenue decline thanks to lower coal offtake, coal-based power generation and e-auction premiums. Power, which contributes 70% to revenue, grew just 1% thanks to lower power consumption thanks to above normal monsoons. On the other hand, profitability has improved, and we'll find out why shortly, says Crisil, with overall earnings before interest, tax, depreciation and amortization, or EBITDA as it's called, grew 10% year on year. So I spoke to Pushan Sharma and put to him various questions. Pushan is the Director of Research at Crisil Market Intelligence and Analytics, and I asked him to walk us through the numbers and why these numbers were saying what they were.
Now, if you look at the performance of corporate India, what we see, it's a mixed bag right now. If you look at the construction-linked sectors and some of the commodity sectors, we're seeing weakness there. Some of these sectors, together account for about 1/3 of corporate India market cap. And we're seeing like sectors, specifically if we talk about, say, steel sector, it's a significant 11% of the market cap of the companies that we've analyzed. And they are down about 2% in revenue. If we talk about cement here, again, they're flat to on the negative side. Even some of the other sectors like ceramic, so there is a broad-based construction sector. We're seeing that there is a lot of weakness that we're observing. And some of this is linked to lower spends by the government post-election. Some of it is linked to lower prices. For example, in the case of steel, we're facing cheap Chinese imports, and that's leading to lower prices and thereby lower revenue. Now, if we shift our focus to some of the export-linked sectors, we see that the pharmaceutical sector is doing well. They're growing in double digit, whereas the IT sector, which accounts for about 16% of the revenue bucket, there we're seeing growth only about 3 to 4% because a lot of the US and European clients of these IT companies, they are not going ahead with non-essential spends. Coming to the discretionary services, this is a segment that we can say that is doing much better than the rest of the pack. Here we're seeing early double-digit growth, whether it is airline or telecom services, the performance is much better. But on the other hand, the consumer discretionary products, we're seeing that it is getting weighed down by the automobile segment, which is not showing a lot of strength. There's a lot of weakness, specifically in passenger cars, commercial vehicle, as well as the tractor side. That's the broader story that we're looking at. Some weakness on the construction and commodity linked sectors, some strength in export linked sectors, and better performance in consumer discretionary services.
How much of this looks like it is following on, or is that all happened in the last quarter?
No, so we've seen that there has been over the last, few quarters, there has been a slowdown that we've been observing. If one looks at the quarterly results of the listed ecosystem in India, we see that till Q4 of fiscal 23, we were seeing double-digit revenue growth. And from Q1 of FY24, we're seeing that there is a slowdown. So this is the 6th quarter where we're seeing single-digit growth. And this has been the lowest in the last 16 quarters, as our report suggests.
How much of this is something that is, or rather seeming cyclical, or I know you've given me the breakdown of why it's happening for each of these sectors, but if you were to take a step back, why is this happening?
What we see is that, there has been the K-shaped recovery that we keep talking about that continues to play in India. We're seeing better performance on the premium side of each of the sectors. So if we talk about cars, we see that small cars are degrowing by 13%. Utility vehicles are growing in double digit by 12%. If we talk about two-wheelers, we see the entry-level two-wheelers are degrowing by 5%. Mid-size and the premium vehicles are doing much better. So in each of the sectors, we see that the premium categories are doing better. What one can attribute that to is that inflation is clearly hitting the middle class more than it would the other segments, the top segments of the society. And that is one of the reasons why we're seeing some level of slowdown. Also, the interest rates, they are slightly on the elevated side, and that's also contributing to this to some extent.
Right. And if you were to give an outlook of sorts, I mean, what could change things? I mean, one is, of course, prices come down. You talked about steel, for example, or commodity prices. What else could be a trigger on the demand side?
So what we're seeing this year is that monsoon has been good. Last year we were at about 6% lower than normal. This year we are at about 8% higher than normal. So the reservoir levels for the upcoming season are going to be good, which should be good news for rural India, which accounts for a large part of India. So that should remain good. There could be some recovery on the rural side if the prices for the crops are supportive. If there are rate cuts across the globe as well as in India, that could also support demand. But on the profitability side, because some of the commodities are down, the profitability scenario is much better for India Inc.
Right. So that's the other broader question. So overall, despite everything else, profitability, according to your charts, has improved by about 70 to 90 basis points. Now, you're also saying that it's led by export-linked sectors. So if profitability is good, and that means companies are doing well, in relative terms at least, why should one be too concerned?
Well, profitability is good because, in case of, say, the IT sector, the attrition rates are lower. The utilization of the resources is better. In case of pharmaceutical sector, which is seeing a sharp increase in margins, about 300 basis points, there the raw material prices have been supportive. But for structural growth in revenue as well as finally profitability, demand sentiment needs to be strong. And that's where we see slight struggle at this stage. And that's where more support is required. There needs to be more percolation of the demand to, the middle class and the lower income groups in India, which is something that is lacking at this stage.
Right, Pushan, thank you so much for joining me.
Thanks, Govind.
The world is poised for trade wars. We spoke of trade wars and rising trade tensions, including between the United States and India if Donald Trump were to return, and its bargaining stance with countries like the United Kingdom. Meanwhile, several countries are already firing their first anticipatory shots. German Finance Minister Christian Lindner on Friday warned that if the United States kicked off a trade war with the European Union, there would be retaliation. Lindner told CNBC on the sidelines of the IMF, or the International Monetary Fund's annual meeting in Washington, D.C., that trade controversy sees never winners, only losers. It's not in the best interest of the United States to have a trade conflict with the European Union, and we would have to consider retaliation, he said. Lindner, according to CNBC, belongs to the pro-business Free Democratic Party, which is currently in coalition with Chancellor Olaf Scholz's Social Democratic Party. The US problem with trading lies mostly with China rather than the EU, Lindner said, adding that the EU should not become a negative side effect of controversy between the United States and China. If a 20% tariff were implemented by the United States, as Trump has been suggesting, the EU and Germany's GDP could fall in coming years, Reuters reported on Thursday, citing a study by a German economic institute. Trade is a key pillar of the German economy, and heightened tensions, uncertainty, and tariffs would hit the country hard. Trade tensions between the United States and China and the EU and China have been rising throughout this year. Both the US and EU have implemented higher tariffs, for example, on electric cars, and China in turn has retaliated with higher temporary tariffs on some imports from the EU. CNBC also reported that earlier in the week, Geeta Gopinath, Deputy Managing Director of the IMF, told CNBC that an escalation of trade and tariff tensions between the United States and China would be costly for everyone. India's new tax code and more feedback. The government has invited suggestions of the Income Tax Act 1961 from the private sector and tax experts beginning October as part of an exercise to simplify the direct tax law. The objective is to simplify the language and reduce litigation. The Finance Minister, Nirmala Sitharaman, in the 24-25 budget presented in July, had proposed that the IT law review would be completed in 6 months, which obviously ends in 2 months. It's also widely expected that the amended IT Act could be brought into the budget session of Parliament next year. The core report is doing its bit to contribute to the discussion on the tax code by asking tax experts across the country for 3 things that they would like to see or not see in the new tax code. In the third installment of this series, I reached out to Himanshu, Parekh, partner and head of tax West for KPMG, and I began by asking him to list out his 3 tasks, which you must listen to.
In terms of the overall objective of this exercise, as was clarified by the finance minister, the objective is to simplify the income tax law. The objective is to make it more concise, lucid, and easy to understand. The objective is to provide tax certainty to taxpayers and reduce litigation going forward. So these are the overall objectives behind this exercise.
And what are you looking at? So if I were to ask you for 3 wish lists or 3 points that you feel this tax needs to focus on, even as it makes it simpler and more accessible, what would they be?
So number one, I would say there are some provisions in the income tax law which are quite complex to understand. The government needs to simplify the drafting of those provisions. They need to simplify it for the layman to understand what exactly is being envisaged in the provision. And what they could equally do in this regard is that it may be good for the government to issue some kind of a commentary to the income tax law, explaining the government's point of view on each provision, what exactly is the interpretation of that provision. And if that explanation can be given with the help of some illustrations, it becomes much easier both for the taxpayer and for the tax administration to understand the law and implement the law. So that's point number one. Point number two, there are quite a few complex provisions in the income tax law where we have contrary tribunal decisions, contrary high court decisions. And tax litigation in India can take anywhere from between 10 years to 20 years to come to an end. And rather than waiting for every issue to go to Supreme Court and then be resolved by the Supreme Court over the next 10, 15 or 20 years, the moment any controversy arises, it may be good for the government to step in and amend the law, and specifically amend the law so as to bring out its point of view on the subject matter and kill the litigation at that stage itself so that litigation does not perpetuate going forward. So that's point number two. Point number three, if you see in India, we have immense tax litigation which is being faced by taxpayers. There are lakhs of appeals which are pending before the appellate authorities and courts today. And it may be a good idea for the government to think of introducing some kind of a mediation scheme whereby the taxpayer and the tax administration may be permitted to settle the dispute in an informal setup rather than getting into a long drawn litigation. So these would be 3 of my major asks to simplify the tax landscape for taxpayers in India.
Okay, let me start with first one. You talked about the drafting and whether the provisions can be simplified. And you also talked about commentary or illustration that runs alongside the act or sections within the act. Can you give me examples of both, where one is in the case of drafting, like for example, which is a section that comes up frequently where maybe if there was simplification, things would be easier. And the second is, again, what is the act you feel where a commentary running alongside or rather a section that a commentary running alongside would really help?
Oh, when it comes to drafting, I would say for example, provisions dealing with taxation of charitable trusts. I think they're very, very complex to understand. Some of the provisions dealing with search and seizure, again, complex to understand and follow and implement. Provisions dealing with reassessment of income, again, little complex to understand and implement. When you talk about deemed dividend, the concept of deemed dividend, wherever a company gives loan to a shareholder or an advance to the shareholder, that loan or advance is deemed to be a dividend. And in such cases, how should the taxation happen, especially if the loan or advance is not given to the shareholder, but to some concern in which the shareholder holds shares? Would the deemed dividend taxability apply to the concern to whom the loan is given or to the shareholder? Is again a moot point. It's an open point. So some of these controversial aspects, I think, will be good if they can be clarified by the government.
And when you talk about commentary and you say that there should be the government's point of view running alongside, again, what's the example that comes to mind first?
That the example which immediately comes to my mind is when you look at the law dealing with international tax. When it comes to double tax avoidance agreements, there's a commentary which has been issued by the OECD. OECD is the forum which sort of takes care of international tax at a global level. So there is a similar to the Income Tax Act. When it comes to double tax avoidance agreements, we have articles of double tax avoidance agreements, and there's a detailed commentary on each article clarifying what exactly does that article envisage, how should one interpret that article, and that gives a lot of certainty both to the taxpayers and tax administration as to how is that article of the DTAA to be interpreted. So something similar we can try and do in India. Similarly, when you look at the US law, there's detailed explanation which is provided in the US tax law for each and every provision of the law, which makes life easier for everybody. So something similar we can try and, incorporate in India as well.
Got it. And you talked about amending the law for cases which are dragging, and that in turn you say or you feel will kill litigation. Now, is there precedence to this? I mean, and because I guess that would be the first question that would come up.
There are lots of precedents to this, Govind. What we've seen historically is that when a controversy arises, the controversy drags on for a few years until the matter reaches the High Court or in some cases the Supreme Court. And if the verdict of the High Court or Supreme Court may not be as intended by the government when the provision was inserted, then thereafter we see an amendment being made to the law. My simple point here is that one does not need to wait for 10 or 15 years for the verdict of the High Court or Supreme Court and then find out as to whether it is in accordance with the intention of the law or not. The moment the controversy arises, the moment it reaches the first appellate stage itself, why not quickly or immediately amend the law so as to clarify what was intended in that provision?
Mediation, which is in some ways a step that precedes this, is a process where, let's say, as you say, the tax authority and the taxpayer could come together and work out, let's say, a sum or a settlement of some sort. Isn't a tribunal or a way of doing that? Or you're saying that this should be taken into an informal context?
Clearly, because what happens in tribunals or courts. So, for example, let me just explain this with the help of an illustration. So, let's say a taxpayer has claimed an expenditure, which the taxpayer is of the view that this is a revenue expenditure and is liable in the year in which the expenditure is incurred. Let's say the tax officer takes a view that this is a capital expenditure which is eligible for depreciation over a period of years. Now, such controversies, when they come up before the tribunals or courts, the tribunal or court will hold either in favor of the taxpayer or in favor of the revenue. There's no via media out there. And what I'm talking about here is a via media. Forget whether it's revenue or capital. Can both the taxpayer and tax department agree that this expenditure over what time frame should be allowed? And let's say both of them agree that if rather than allowing it as a revenue expenditure in year one, let it be allowed over a time period of 3 years. And if both are agreeable, then there's no controversy at all. The matter gets closed then in that itself.
So there is a way, for example, that you could get an opinion on the treatment of tax beforehand that the current system allows. But is there space in the current system to do what you're saying?
So now it's not. And that's why this recommendation. And we've seen this happen especially in advanced countries. We've seen this, actually being in force out there. It's been a big success story overseas, because when you look at countries other than India, you hardly find any tax litigation in those countries. And the prime reason for that is most of the disputes get settled between the tax authorities and the taxpayer right at the beginning.
Right, Himanshu. Thank you so much for joining me.
Thank you, Govind. Always a pleasure talking to you. Bye-bye.
Travel trends are changing. The biggest travel trend for 2022, if looking back, was to go big, spend big, with everyone booking bucket list style trips to places like Bali, Rome, London, and Paris. 2 new reports show that travelers have changed and are in a different headspace, according to CNBC. Trend reports from Expedia and Booking.com show that vacationers are now foregoing splashy trips to global hotspots in favor of quieter trips to places that are less known and far less crowded. 63% of travelers said that they are likely to visit an off-the-beaten-track destination on their next trip, according to Expedia's Unpacked 25, a travel trend report which looked at about 25,000 respondents from 19 countries. Flight searches from Expedia from September 23 to August 24 already show rising interest in places like Reims in France, Brescia in Italy, Waikato, New Zealand, Abu Dhabi, Cozumel, Mexico, among others. One reason, says Expedia, is that many destinations are becoming quite overcrowded and a lot of the travelers want something different. The other, of course, is cost, because these oft-targeted destinations have become quite expensive. Airlines are also responding to that. CNBC says United Airlines announced this month that it's expanding international services to Senegal, Greenland, and even Mongolia next year in a bid to capture travel interest to the next IT destination. And then Booking.com's own study has concluded that travelers share a desire to explore less visited locales and an increased desire for authentic, off-the-beaten-path experiences. 67% of adult travelers they surveyed too said they wanted to visit less crowded destinations, and they spoke to about 27,700 respondents from 33 countries. Bookings lists include Sanya in China, Joa Pessoa in Brazil, Okinawa in Japan, San Pedro de Atacama in Chile, and Houston in the United States. Booking also says that more travelers are embracing something new called JOMO, or joy of missing out. 62% of surveyed travelers said that JOMO travel reduces stress and anxiety, and nearly half say it allows them to better reconnect with loved ones. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.